Hi folks, welcome to the channel. I'm Aston Collins. Before we get into investing, let me tell you what we are, who we are, and why we're here. I've been an investor for over 30 years, not as a Wall Street guy, but as someone who learned as a regular Joe through experience, trial and error, and lots of mistakes along the way, and common sense, I may add. And I'm here to share all of that with you today. What we're here to do is we're not here to sell you anything. Let me repeat that. We are not here to sell you anything. We are not like the other guys on YouTube who would tell you after you watch for 2 or 3 minutes, and then they tell you click on the other side. Click on the button below. When you click, they say meet me on the other side. You meet them on the other side, and then what they told you was free, it's now $150 or $250. They want to charge your credit card and want to sell you stuff. Okay? That's not what we're here to do. That is not right. That is wrong. We're here to give you valuable information that will change your life. Not just your life, but that will change your life and your family lives. We are here to help you create wealth. To not just create wealth today, but generational wealth. Because we don't think only the rich and the powerful should be able to do that, or should have access to such key information that, in my view, every American should have. They don't teach you this in school because they don't want you to be smart. They want to keep you in your place where you are. They don't want you to create wealth, generational wealth, like the rich, like the wealthy. But we're here to change that. Like I said, I've been an investor for over 30 years now. I've learned, and I'm here, and I'm still here, and I'm here to share what I've learned with you, me and my team. We're here to do that. This is an educational platform. We're here to give you information to educate you. It's free. So what you need to do, you need to take notes. If you don't have a notepad and a pen and a paper, you need to open your phone and go in your section where it says notes and take notes. Because the information that we're giving you today, I can guarantee you will change your life. Not just today, not just for tomorrow, but forever. So, let's dive in. Let's first talk about, before we get into this, let's dive in and let me share something that Warren Buffett said. One of the most successful investors of our time said about what to do with his family money when he's gone. This is what he said. What his wife should do with the family money when he's gone. He said this to his trustees. Okay? Put 10% in short-term government bonds and 90% in very low cost S&P 500 index fund. That's it. No hedge funds, no stock picking, just simple, consistent investing in America's biggest companies. If that strategy is good enough for Warren Buffett's wife, it's good enough for us. Okay? Let's be real. I read every book Buffett ever written. Okay, I know what the guy had for lunch, how much he spent, $20 on lunch. So wise guy. So if If he's saying that, I'm on board, and you should be too. Okay? Now, so if you ever thought I wanted to invest, you wanted to invest, your family member wanted to invest, but I don't know where to start, this video is for you. Okay? So let me repeat that. So if you ever thought, I want to invest, but I don't know where to start, this video is for you. I'm breaking it down in plain English. Nothing complicated. No confusing financial talk. No hype. Just real advice for real people. Whether you have $50, 500, 10,000, this video will give you the tools to start investing smartly and confidentially. All you have to do is pay attention and listen. That's all you have to do. Now, let's talk about what is the stock market. You've heard this many times on radio, social media, the nightly news. People talk about the stock market going up, it's going down, it's going up, it's going down. Have you ever sat down to think what the stock market is? Have you? That is why we're here. We're here to educate you about investing, so we need to start from scratch. Okay? So, what is the stock market? You need to pay attention. What is the stock market? The stock market is where people go to buy and sell ownership in companies. That is called stocks. That's what the stock market is. When you buy a stock, you buy a piece of a company. You become an owner of that company. Okay? Now, imagine this. Think of this as buying a piece of a slice of your favorite pizza at a pizza shop. Okay? The more pizza that they sell, the bigger the pie would be if you own a part of that pizza shop. Okay? The value of your slice is worth more the more the company sells pizza. Okay? That, my friend, is investing in a nutshell. It's not complicated. It's all about ownership. Now, the other most important question is, why should you invest? People ask that all the time. Why should I take the risk when I can put my money in a savings account, when I can buy a treasury bills, or I can buy government bonds? Why do I need to put my money in stocks? Okay, now, that's a very good question, but we're here to answer that for you. Saving money is important. It's true. But it won't build wealth. Saving money is important, but it won't build wealth. Inflation slowly eats your cash over time. Okay? So, investing lets your money grow faster than inflation. Okay? Historically, the stock market returns 7 to 10% a year. That's not bad. Over time, in 30, 40 years, 7 to 10% a year is very good. Okay? Now, that is how investor build retirement funds, and they get also financial freedom by doing that. You don't need to be rich. All you need to do is to start. That's all you need to do. You need to start today. That's all you need to do. You don't need to be rich. You don't need a lot of money. But we'll get to how much you need. So that brings us to the next question. What is inflation? You hear this all the time during the election. Harris, inflation, bring it down, bring prices this down, Trump, blah, blah, blah. They all talk about bringing inflation down. But here's the bottom line. Harris lied to you, Trump lied to you, because the government cannot control inflation. The private sector controls inflation. The Federal Reserve can have a hand in that. But at the end of the day, prices goes up because of demand. And there is nothing the government can do about it. If there's demand, the prices will go up. If everybody likes this pen, this beautiful pen, if everybody likes it, and I say it's $40, and a million people buys it, and then I say it's $50, and another million people buys it, and then I say it's $80, and another million people buys it, guess what? This pen is really not worth that much, right? Even though it's worth much more than that. Well, let's say it was worth $2,500 for this pen. Okay? So what happens here? The government has nothing to do with this pen being $2,500. This pen used to be $80. Now it's $2,500. And the reason why this pen is $2,500 is because of demand. People want it. They love it. And if I tell them it's $3,000, they buy it. There's nothing the government can do to bring down the price of this pen. That's inflation. And if someone else tried to make a pen that looks like this, then everybody else tried to make a pen that looks like this, maybe that would help to bring the price down right now, because everybody making the same pen that looks the same. Right? So I would have to do something else to make my pen a lot better than all the other guys that try to copy me to beat them, so I can make it $5,000 from $2,500. That is inflation in a nutshell, and the government cannot do that. Only the people in America and across the world who buys this pen can bring the price back down if they stop buying the pen, and then slowly the price will come down. So the fact that Trump is telling you he can bring inflation down, Harris said the same thing during the election, they both lied to you. It's not true. Okay? So, well, let's get back to what we're talking about here. So what is inflation? Inflation is the rise in price over time. So what it does is your money buys less over time. That's what inflation does. Okay? A loaf of bread that used to cost $1.50 10 years ago, that loaf of bread today is now $6.99 or $7.99. From $1.50 10 years ago, you're not paying $6.99 or $7.99. I tell you something, I'm not making this up. It's happening today. If you go to Whole Foods or you go to most grocery stores now, they have just the basic bread. It's close to $6.99. 10 years ago, that bread used to be $1.50. So it's happening now as we speak. Inflation is high. Okay? The price is not going down. No business will lower the price because the government asked them to. It doesn't work that way. And once businesses raise the price, they don't bring it back down. So that is why it's important for your money to keep going up faster than inflation. So it brings us back to the question, what is inflation? It can be many things for some people, and who controls it? The consumer controls inflation. The business people controls inflation, not the government. So let's get that clear. So if your money is sitting in a savings account and you earn it 1%, if you earn it 1% and your money is sitting in the savings account and inflation is 3%, you're losing out. You're losing value. Your buying power is disappearing like the wind. Okay? That's not what you want. You want your money to be growing faster than inflation. That is why investing is so important. And that is why we're here to help you. So, now, that brings us to the next important question. What do you need to start investing? What do you need to start? Very important question. You don't need a finance degree. You don't need 10, 20,000. You don't need any of that to start. Most brokerage firms today will have you open an account with almost anything. But I would recommend that you start with 250. Okay? Because that would most brokerage firms, reputable ones, well, if you went into Money Link or Money Average with them, opening your bank account with them, opening a brokerage account with them on a run roof, they will let you open a brokerage account for $250. So long you will be adding money from your bank account to your brokerage account through MoneyLink every month. Say $20, $30 every week, every 2 weeks, every month. Whatever you can afford. Okay? Your brokerage firm would agree to that. Okay? And in return, you need to make sure that your check is going in there every 2 weeks or every month. Okay? Now, you don't have to do that. If you want to keep your bank account with the bank you have already, that's fine. It's not what I would recommend, but if that's what you want to do, you could leave it that way and just do a money link through your brokerage account with your bank account. A money link is where your brokerage account will communicate with your bank and take money out and move it into your brokerage account automatically every month through MoneyLink. So for $250, you can open the brokerage account. Now, other smaller brokerage firms will let you open the account almost nothing. Okay? So what do you need to start? You need a brokerage account. That's number one. I said 250, okay, or less. Now, this is the most important, one of the most important things about investing. You need a long-term mindset. A long-term mindset. Investing is a long-term game. You don't get rich by investing overnight. You're not going to get rich. Okay? It's a long-term game. It's a long-term mindset. Remember that. Now, and don't worry, this is not complicated. Opening a brokerage account, my friends, it's easier than opening a bank account. I know that sounds funny, right? Back in the day, it was the opposite. It was more complicated to open a brokerage account than a bank account. Now it's just the opposite. Today it's more complicated to open a bank account than it is to open a brokerage account. Go figure that one out. Anyway, so let's get back to what to invest in. Okay? We talked about how important it is to invest. We talk about that, right? So, now, let's get to what to invest in. We talk about Warren Buffett and index funds, right? We know that diversification. You need to diversify. Okay? We talk about that. But now it brings us to the most important question: what to invest in. we talk about index funds, which is blue chips stocks. Blue chip stocks would be companies like Apple, Microsoft, IBM, Coca-Cola, Pepsi. Those are blue chip stocks. Companies that you know and you love. Okay? Now, these companies have been around for so long and they're reliable. And many pay something called dividend. Okay? Which brings us to the next section. The S&P 500. What is the S&P 500? You hear this all the time. You hear it on the social media, the nightly news. You from politicians that talk about the S&P 500 is up 20%, is up 30%, yeah, it's up 2%, it's down 10%. Out of that, you hear about it all the time. But have you ever asked yourself, what is the S&P 500, my friend? What is it? Now, the S&P 500 stands for the Standard & Poor's 500 Index. It's a list of the largest 500 companies, traded companies in America. The largest publicly traded companies in America. That is the S&P 500. So you know these companies like Apple, right? Amazon, Coca-Cola, J&J, Johnson & Johnson, right? You know these companies. So when you invest in the S&P 500, you are owning a piece of all of these companies. Okay? All of these companies. That means you are automatically diversified by investing in the S&P 500. You automatically diversify. Okay? That's a good thing. Which helps reduce your risk. Because investing is risky. So by investing in the S&P 500, you reduce your risk. It's common sense. And that is why Warren Buffett recommended this for most people, including his own family. We talk about that. Now, this brings us to the another most important question. Okay? This brings us to dividends. We talk about that. You hear this all the time. The dividends here, the company's having a tough time, so they cut their dividends. They got rid of the dividends, so they're adding more. They're adding 3 cents more to the dividends because business is good. The other guy is going out of business for bankruptcy, so they give up that dividend. You hear about it all the time, right? Okay, but we're here to tell you what is a dividend. What is it? Let's break it down. A dividend is a payment that a company gives to its shareholders. You, me, if you own a company, say like Coca-Cola or Microsoft, that pays dividends, or American Express that pays dividends. Okay? Basically, what American Express or Coca-Cola is doing, if you own their stock and they're paying you dividends, they basically, it's to thank you for owning their stocks. That's what they're doing. They're saying, thank you, my friend. Thank you so much for owning my stocks. And because we love you so much and your ownership, so we're going to give you something called dividends as free cash. To say thank you, gratitude. It's a beautiful thing. Now, so let's just say you own 10 shares of a company that pays $1 a share, right? Let me repeat that. You own 10 shares of a company that pays $1 a share. Okay? So what happens? With that the dividend is paid every 3 months, every quarter, every 3 months, right? So if you own 10 shares of a company and they're paying $1 a share, That means the company is giving you free money. Okay? Every 3 months, you would get $10 for owning 10 shares of that company. It's a beautiful thing. Now, if you own 100 shares, you get $100. If you own 500 shares, you get $500. Right? If you own 3,000 shares, you get $3,000. If you own 1,000,000 shares, you get $1,000,000. That is the magic of dividends. That's why the rich love dividends. Okay? Now, that's what dividends is. What's so good about that is, you have to remember one thing. Not all companies pay dividends. The most established companies, the best managed companies, with a lot of cash, they pay dividends because they have a lot of cash. They're running their business very well. They're generating a lot of cash. So in return, they pay you some money for holding their stocks. And they're telling you not to sell their stocks. Basically, that's what they're doing. They say, we're gonna give you all this dividend, so please don't sell the stocks. They don't tell you that, but that's what it means. They're not paying you dividends so you can sell the stocks. They want you to hold it, so the price can go up. Okay? That's the idea behind it. So remember that. Now, so let's talk about what you can do with the dividends. That $10 that the company is paying you every quarter, what you need to do as an investor, you need to reinvest the dividend. So when you go into your brokerage account and you're going to see the boxes, you're going to see dividends here, dividends there. What to do with it? Reinvest the dividends, yes or no? You click on yes, and you walked away. All of this would happen automatically every quarter. Your brokerage firm would take whatever dividends that company X is paying you, or company Z, or whatever name you want to give it today. They would just automatically buy more shares of that company. So over time, if you own the 10 shares that you own, within a year or so becomes 20 shares, 30 shares. As the stock price goes up, you get more value because the price is going up and you're getting more shares. It's a beautiful thing. That is the magic of reinvesting your dividends. You don't take the cash. And what the other most beautiful thing about this is, you don't pay any tax. There's no tax. So they give you free money, you reinvest the dividends, you don't pay any tax. What more do you want? That is the magic of investing. And that is the magic of dividends. Okay? So, and what happened over time, when you reinvest dividends over time, what that does to your portfolio, it's supercharged. You know? It's like, it puts your portfolio on steroid. Supercharge your portfolio. That's what it does. So reinvesting your dividends, my friend, is magic. It's a beautiful thing. And it's like getting money. It's like getting paid while you sleep. That's what dividends is. Why do you go to bed every night? Your money is working. They're giving you free money. What more do you want? Now, this brings us to a fundamental question, a very good one. Why wealthy investors love dividends? I just explained it to you, but let's get a little bit deep into this. We'll come back to Warren Buffett, right? Warren Buffett's company that he managed with his team, the Berkshire Hathaway company, right? Berkshire Hathaway owns massive stakes in dividend-rich companies like Coca-Cola, Apple, and American Express. Now, this is going to shock you. His stake in Coca-Cola earns over $700 million a year in dividends alone. Now get this. Warren Buffett, Berkshire Hathaway, made $700 million a year, not by selling Coca-Cola stocks, because the stock price, to be honest with you, is not going anywhere. It's not moving much. But just by holding the stock, Buffett, Berkshire Hathaway, made 700 million a year. 700 million. Coca-Cola paid the Berkshire Hathaway company free money through dividends. It's a beautiful thing. And you can do the same thing as well. You can do exactly the same thing. That is the magic of dividends. Okay? Now, let's move on. Remember, when a company pays you dividends, you don't have to sell the shares. Keep the shares. Don't sell the shares because they're paying you for owning the shares. Okay? So you can wait longer. If the stock price is not going up but they're paying you dividends, why would you sell the share? It will be stupidity. So you don't do that. It's called common sense. Okay, so let me just add this. That, my friend, you hear the term all the time. Since you're a little boy or a little girl, you hear people say the rich get richer. Well, the rich get richer because the rich are smarter than you. The rich, they're smarter than us when it comes to money. Okay? That's why they get richer. Something like dividends. If you're rich, if you own, 5 million shares in a great company, and they're paying you 2% of $3 per share, and you own 10 million shares, you don't have to sell the stocks. So the rich always get richer because they're smarter than you and they're smarter than me. Right? Rich people are not stupid, but we can learn from them. When it comes to investing, we can learn how to make money. We don't have to hate them. Look at me. I'm doing well. I'm not a rich guy, a rich guy. I'm not a billionaire, but I'm not doing bad. Okay? And so can you. If you learn about investing, reinvesting your dividends, and investing in great companies, you will do well too. So let's move on. Now, let's look at, let's look at some of the common mistakes to avoid when it comes to investing. Okay? Investing is like everything else in life. It's not perfect. You will make mistakes. There is not one investor that would tell you that everything they did was right. They will be lying to you. You look at that one, I made lots of mistakes. Lots of them. But what I learned from those mistakes was a blessing. It was a blessing, like a blessing from God. Okay? Those mistakes made me, Aston Collins, a better investor. And that is why I'm here looking so good and talking to you. Because I went through all of those mistakes. When you make mistakes as an investor, you become a better investor. Now, if you make mistakes as an investor and you don't become a better investor, then you're just stupid. Then you're just a fool. Okay? You must well shoot yourself or do something else. I'm just kidding. Don't shoot yourself, by the way. Anyway. All right? So don't do that. Anyway, but you get the point. You should learn from your mistakes. Everything in life, not just investing. The reason why we make mistakes, is to make us a better person, right? A better human being. We can't know everything. We have to get things wrong to get things right. All of the great inventors, they never sat down and invented something and it worked the first time. They had to keep trying and trying, and one day it worked. So you can call that mistakes. But I'm here, and I'm talking to you. That means I learned, and that's why I'm sharing what I've learned, so you don't make the same mistakes. So let's Talk about it. Common mistakes to avoid. Here's what I have learned the hard way. Number one, this is very important. Pay attention. This is very important. Number one, don't panic when the market dips. It is known. Let me repeat this. Don't panic when the market dips. It is known. Okay? Number two, don't put all your money in one stock. Diversify. We talk about that. We talk about index funds, right? We talk about index funds. Don't put all your money in one stock. Diversify. Okay? Number three. Now, this is one of the most important things that you need to know when you sit down and you take your family money and your paycheck or your wife's paycheck, combine it together, and you say, this company is so hot, you're going to put all the money in there because this thing going to go up and we're going to make 20 grand. We're going to take that great vacation. We're going to take the vacation of our lifetime, right? We're going to go to 20 different countries, right? We're going to take the whole family. So you're going to do this. Okay? This is what I'm here to tell you. This is number three. Don't invest money you need next month. Let me repeat that. Don't invest money you need next month. Don't. Okay? Investing, my friend, this is a long-term game. Money you need next month, don't invest it. Okay? I've made those mistakes in the old days. You're looking at a guy who did that. Don't do it. Don't do it. It never works. Okay? Now, so this is how you should think about investing. This is important. Take note. Pay attention. Think of investing like planting a tree. You probably heard this before. I'm not the first one who's saying this, but I gotta repeat this. Think of investing like planting a tree. You water it, you give it sunlight, right? And you let the tree grow. That's what you do. You water it, you give it sunlight, and you let the tree grow. You don't dig up the tree every week to check the roots of the tree. You don't do that. That, my friend, is investing. Investing is a long-term game. Imagine and think of it that way. Like a tree that you water, that you care for. And over time, you will see that little tree would grow and turn into a big tree. That's investing. It's a long-term game. Now, let's move on. How to stay consistent. This is important. You've heard this before. Everything in life is about consistency. It's not good in life if you do things one day and then the next day you don't do it good. If you're a restaurant owner and every Friday, every Saturday, you have the best food. The chef is magical on Friday and Saturdays. But if you go to the restaurant on Monday and Tuesday, The food is terrible. And you go on Thursday, it's terrible. But come Friday and Saturday, all of a sudden, the chef is sitting down with God or Jesus Christ, and he or she is doing something magical when you go to this restaurant on Fridays and Saturday when it's packed. The food is awesome. But when you go on Tuesday, Wednesday, and Thursday, the food is horrible. Now, how long do you think that restaurant would survive? How long do you think? What kind of a review they're going to get? My bet is they will be gone in 6 months. So think of investing that way. That is why consistency in investing matters. You have to be consistent. So let's get into consistency. The question is, how do you stay consistent in investing? How do you stay consistent? Because consistency will keep you in the game. When everybody's fleeting, you will be the last guy standing because you understand the game. You don't have to flee with the rest of the fools. The sheeps, they line up the ducks and they run in line. But the consistent guy don't do that. The consistent guy is smart. You smart, and you want to be consistent, like me. This is what I do. I invest. I know the game. I play the fucking game. It's my game. We all know, we all have things that we're good at. You're probably good at things that you do. I'm good at investing. That's what I do. I'm good at politics as well because I know investing and politics comes together. It's like love and marriage. You can have one without the other. So, let's get back to consistency. So how do you stay consistent in the market? What do? You set up, you set up automatic investments. Okay, listen to this, write it down, take notes. You set up automatic investments with your brokerage firm and your bank. Now, my advice to you is to have your brokerage firm, your brokerage account, and your bank account with the same company. It makes, believe me, it makes your whole life easier if you do. When you want to move things around, you want to move money around, it's much easier if your money is under one roof. Okay? When you become a billionaire, then you can move your money around. But you're not a billionaire, so you don't have to worry about that. Under one roof is my advice. Lots of companies like to do that. I'm not going to give you names because I'm not being paid to do that. Okay? So I'm not going to give you names. But look it up. Okay? So set up automatic investments where every week or every 2 weeks or every month your brokerage firm will take out $30, $20, or whatever you can afford and from your from your checking account and put that in your brokerage account to buy stocks. Okay? That's what they would do. And they would do this automatically. So when you're on vacation or when you're sick, that you forgot, that automatic setup will continue to work. Okay? So long you have a paycheck and money coming in, they will continue to do that automatic investment in your account. Okay? It's easy to do. It takes no more than 20 seconds. Just click and it's done. Okay? Now, we talk about reinvesting your dividends. That is consistency as well. You're staying consistent because you put that automatic, order that every quarter, every 3 months. Your brokerage firm will reinvest your dividends automatic. You don't have to do anything. You can be in space and they will do it for you. Okay? It's automatic. Now, this is the other most important thing. You may not be a wise investor yet. You may not know much about investing yet. But this is what you have to do. Track your progress. Because when you track your progress, you become hopeful. Okay? When you see your $50 turn into $100, turn into $500, turn into $1,000, turn into $1,500, You feel good about it. You want to know about it. So track your progress. I'm not telling you to look at your portfolio every day. That's not what I'm saying. Track your progress. Meaning, if you own shares of Apple, let me give you an example. If you own shares of Apple or American Express, you want to know how the Apple products are selling. You want to know when they're coming up with the next iPhone or whatever else they're doing, what kind of a response the consumer, the review that they're getting from the consumer. Is the phone selling well? Is the management, these are things you want to know. It's not because you don't like to own the stocks, but you are part owner of Apple now because you own their shares. So you need to track their progress, right? You need to know these things. You can go to apple.com, go to their investor section. Now, don't go on apple.com to look at the phones. Go to the investor section, what they're saying, what the public's saying. Look at the statement. Look at what the media is saying about Apple. Read that. If you want to get deep into it, call their investor relations department, and they will be glad to tell you everything that Apple is doing. One of the key questions you need to do is to ask them, what are the supplier telling them? Okay, that's how you really would know what Apple is doing. The supplier running out of supplies. Can they make the phone fast enough? What's going on? They would tell you all about it. These are information that Apple have to tell you. You don't have to be a wealthy investor for them to tell you. They would tell any shareholder who calls them and asks them those questions. They would tell you. They have to tell you because it's the law. Okay? So, track your progress. Read your statement. When you get that statement, every quarter from your brokerage firm, read it. If you can't read it, hire someone to read it for you. Okay? But we will teach you how to read that. We're not there yet. Remember, we're here to give you information. As we'll come up with more series, we will get into that. Okay? Look at the numbers. It's a common sense thing. If you started your portfolio with $1,000, okay, and within 5 years your portfolio is now $10,000, well, that means you're doing well, right? It's common sense. $1,000 is now $10,000. Not too bad. Okay. Now, so let's move on. And the other thing you have to do is keep learning. You want to keep learning. This investing may not be your job, your day job. But my friend, you work for your money. It's your money. And if you're going to put it in companies, excuse me, you want to know what they're doing with your money. You want to know if the management have changed. Okay? They have a new management, if the new management up to the job. What is happening politically would affect your investment in that company. It could help or it could damage it. Either way, you want to know these things. So you have to keep learning. Read books. Read magazines. Okay? But what you don't want to do, you don't want to watch CNBC. I would tell you, don't watch CNBC. Because CNBC is the junk of investing. Okay? If you want to lose your money, you watch CNBC, you will lose your money. Because the guests that they bring on the show, these are all crooks in suits. The smartest investor in America don't go on CNBC. We don't even know who they are because they don't go on television. The guys that go on CNBC, they want to sell you something. Okay? They already own something. They want to prop up the stock that they own, so they tell you to buy it. When you buy it, then they sell it. Okay? Those are the people who go on CNBC. And CNBC doesn't do a background check on these people. They don't care. CNBC is in the entertainment business. CNBC is the entertainment business. Okay? That's what they do. They entertain. They took business and made it into entertainment. So my advice to you, don't watch CNBC. Don't get your investment advice from CNBC. That is my advice to you. It will save you money. Okay, so let's move on. Consistency. So, you keep learning. We'll call it that. Now, you don't need to be perfect when it comes to investing. You don't need to be perfect, my friend. Okay? No one is perfect, but don't try to be perfect because you can never be perfect. And of course not in investing. You don't need to be perfect. But what you need to do, you need to be consistent. That's what you need to do. So write this down. Take notes. You need to be consistent when it comes to investing. Consistency at the end of the day will be your best friend, okay, in investing. Now, let's look at real life examples, right? We talk about a lot of things today. Now, let's look at real life examples. What is it? Let me give you an example for my journey. I started with blue chip stocks, and we know what blue chip stocks is, right? Apple, IBM, Microsoft, etc. I started in the early 90s, okay? I owned some paid dividends that I reinvested those dividends for years, okay? I've held index funds through recession, through booms, and everything in between. Now, here's the key. Here is the key. I didn't sell when things got scary. I told you I made a lot of mistakes. When I learned those mistakes, I didn't make them again. So, when things got scary, I didn't sell. Because I had great companies in my portfolio. I didn't need to sell them. Because what was happening around those great companies was not coming from inside the company. Common sense, right? Why would I sell a great company that is making money and doing well, successful, and the market goes down? The market went down because of something else, not because of the companies that I own. So why would I want to sell them? It makes no sense. So I didn't. Okay? Now, that's the key. That is the key. I didn't sell when things got scary. I stayed the course. I stayed the course. I didn't sell anything. Okay? Now, at the same time, I've seen friends panic and pull out of the market during downturns. Okay? Only to miss the recovery. I've seen that happen many times with people I know. Okay? Now, this is the sad thing about investing. Okay? Say, for example, you purchase a stock at $20 a share. Okay? Company is doing well. The earnings was great. They're going to be making more money. The profit margin is going through the roof. From 8% it's now 18% and higher. The next quarter would be even higher. Seriously good, business good. Cash is coming in. Okay, every day. Something happens. The market tanks overnight because of something political or because of the fear of inflation. Okay? Or fear of recession. So the stock market goes down 8-10%. What do? Those people, my friends, that I used to know, you now own that 20 shares. You decide you're such a smart guy or smart girl. You watch from $20, it goes to 15, it goes to 10, it goes to 5. Okay? And you're sitting there in front of the computer and you say, oh my God, I can't take this anymore. I bought this thing at 20. Now it's at $5. I got to take what's left. So you sell your stock at 5. Okay? You sell your stocks at 5. You've bought it at 20. Okay? 6 months later, 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 6 months la Your stock that you sold at 5 is now $60 a share. You bought it at 20. You sold it at 5. 6 months later, it's $20 a share. It's now $60 a share. What do? You lost your money. You lost your money. The only way you can own that shares again is to go back in the market and buy it at $60 a share. Now, you wouldn't do that because you used to own the damn stock at $20 a share, but you were so dumb. Maybe you're not so dumb, but out of fear. And you listen to the guys on CNBC, if that's where you got the information from, and they told you to get out, and you did. Okay? Now, you can't go back and buy, you feel like a fool if you go back and buy something that you used to own at 20, now you have to buy it at 60. And you hope it's got to go from 60 to 70 or 80 for you to make money. You're not going to do that. You're going to look to buy something else. Because most investors don't do that. Okay? Now, those are the things. That is the reason why you need consistency. Okay? That is the reason why you need to stay the course. Okay? Because these are things that when the market recovers, if you're not in the market, you can't make money. It's common sense. You have to be in the market to make money when the market recovers. And I can tell you something. We know the reality of life, right? We know when you come into this life as a baby, there's only one way you're going to leave this earth. Everybody knows it. We don't like to pay attention to it. But you would have to die. There is no way you're going to be born as a baby and you're going to leave this life alive. If you're born, you will die. Right? It's a guarantee. If you get a job, you have to pay taxes. It's a guarantee. Right? We know that. No difference. It's the same in investing. The market will go up. The market will go down. That's a guarantee. So when the market goes down, you buy more of the market because the market will go back up. That's a guarantee. But people don't think that way. The same way people don't think of a death. When they're born as a baby, they know they can't leave this earth alive. They don't think about it. But we know that's the reality. People don't think about it. When they get a job, they have to pay taxes. They never think about it. The same thing in investing. People don't think about it. When the market goes down, they think the market is going to stay down. That's why they sell their stock. But if people had common sense enough to understand that when the market goes down, it's a buying opportunity. It's not a time to be selling the stocks. They don't do that. And these are smart people. Anyway, you get the point. Stay the course. You will miss out on the recovery if you're not in the market. Will you get that? Okay? I hope you took note of this. That's important. Now, on the other hand, I've also seen people, friends, that started late in the game. As a matter of fact, I know this lady, she's in her 40s. So she was hesitant to start investing because she figured she was late to the game. In any case, I convinced her to get in the game. She did. She started by putting her money in index funds. Over time, through reinvestment of dividends, etc., she's on course to retire early. It's amazing. Okay, so there are some amazing stories. Okay, so here's the deal. This is not a theory. Investing is not. It's real life. Remember, if I can do it, you can too. If I, Aston Collins, can become a great investor, so can you. You just have to pay attention. You have to listen to what we say and what I'm saying, and I can guarantee you, you will do well. I can guarantee you, you would create wealth. I can guarantee you, you would not just create wealth, you would create generational wealth. Okay? It's not going to happen overnight, but you have to start. Okay? So let's move on. If you have made it this far, you are already ahead of most people. I'm complimenting you. If you have made it this far, you are already ahead of most people. Remember that. And think about this for a second. Pay attention. Pay attention. Take notes. Investing is not about luck. Let me repeat that. Investing is not about luck. You will hear people say, investing is like going to Vegas. If you ever hear that from anyone, tell them they're a fool. They just a dumbass fool, okay? If you ever hear anybody trying to tell you that investing is like going to Vegas, okay? They just have no brains. Don't even listen to them. Don't take them seriously, okay? So investing is not about luck. This is what investing is, my friend. Investing is about discipline. Okay? That is what investing is. Discipline is what investing is. You know, if you have a family, if you had a family and have a family, and you have kids, how did you raise your kids? Right? Did you discipline your kids? Did you teach them right from wrong? Did you teach them to be respectful to the sick, to the poor, to the old? Did you teach them to be respectful to everyone, no matter what people look like, no matter what people sound like? That they should treat everyone the same way. Did you raise your kids that way? When they misbehave, did you take care of them? You know, the way you know how? Did you take away their allowance? Did you lock them in the room for a few hours? Did you say you're not getting that gift that I promised you because of your behavior? Okay? Did you tell them you have to take the trash out every day for 1 month? No matter the weather? How did you discipline your kids? Because if you didn't discipline your kids and you let them just run wild, my friends, I don't think your kids would be doing well today. Would they? Are they? Be honest. No difference when it comes to investing. Discipline is what wakes you up in the morning. Discipline is what makes you be the best that you can be every day, no matter what you do, no matter the line of work that you do. Discipline keeps you in the game. And in investing is key, because if you don't have discipline in investing, then you will never win. Then everything I'm telling you will never work. You need that. Okay? So, drop a comment below if you have got questions. Hit that subscribe button. Okay? It's going to help the network. Okay? If you want us to be around to give you more free information, how to create wealth, how to create generational wealth, well then, click the subscribe button. Remember, we're not selling you anything. We're giving you free information. So we're helping you, so you help us. You click the button. We're not begging you. We're just telling you to do what is right. So click the button. Okay? The subscribe button. Tell your friends. If you want more real world investing, advice from someone who's been through the trenches. You're looking at someone who lost it all and came back. Okay? Okay? I've owned companies that went bankrupt. Not because of anything I did, but because they croaked their books. I lost it all, but I came back. You know? That's why I'm here. I've been through the trenches. So what I'm telling you, I know. I've lived it. This is what I do. Okay? So, my friends, click that subscribe button. Do your job. Let us do our job. And we will be back. Share this video with a friend who's been saying, I need to start investing, but hasn't taken that first step. Okay? Send them this video. Share this video with them. And remember, now, this is very important. I want you to remember this. When you open your account and you start investing, no matter how much you can afford, 20 bucks a week, 20 bucks every 2 weeks, 20 bucks a month, it doesn't matter. But once you start investing, it's important you remember this. Write this down, because this is going to save you a lot of money. This is going to help you stay consistent. This is going to help you stay disciplined. So write it down and read it every now and then so you remember. So this become a part of you. Okay? This is it. It's not about timing the market. Investing is not about timing the market. The people who time the market never wins. You cannot time the market. You will never win. I cannot time the market. I will never win. Okay? So the fools who think they can time the market, they always lose. They never tell you what they do. We know who they are. They want to tell you when they win. Okay? Don't never time the market. Investing is not about timing the market. Remember that. It is about time in the market. Let me repeat that. Investing is not about timing the market. Investing is about time in the market. That's what you want to be. You want to always be in the market. Time in the market. I'm Aston Collins. I will see you in the next one.